SMEs, Basic Financial Instruments. Let us first define what financial instruments actually are. Some people, if not most, think that financial instruments appear only in the financial statements of banks, insurance entities, and other financial institutions. Well, they are wrong. Partly wrong. Virtually all entities possess financial instruments and report them in their financial statements as cash, accounts receivable, accounts payable, and bank loans. To give you an academic definition, a financial instrument is a contract that gives rise to a financial asset on one entity and a financial liability or equity of another entity. To make it simpler, imagine an entity which buys goods from a supplier on account. This transaction gives rise to a financial liability or accounts payable on the part of the buyer and a financial asset or accounts receivable on the part of the seller. The seller here has a right to receive cash, and the buyer has an obligation to pay. Some examples of financial assets besides cash and accounts receivable are notes receivable, bonds receivable, loans receivable, and investment in shares or other equity instruments issued by entities, such as financial assets held for trading. On the other side of the coin, we have financial liabilities. Some examples are accounts payable, notes payable, loans payable, bonds payable, and preference shares with mandatory redemption date or preference shares redeemable at the option of the holder. Now that we understand what financial assets and financial liabilities are, let's not forget that equity instruments also exist. Well, an equity instrument is any contract that evidences a residual interest in the asset of the entity after deducting all of its liabilities. Some examples include ordinary share capital, preference share capital, and warrants and options to subscribe or purchase a fixed number of ordinary shares for a fixed amount of each or another financial asset. So you might be asking why I'm giving you these facts, since everything mentioned before this moment of this video applies to full PFRS. Well, full PFRS and PFRS for SMEs have the same definition of financial instruments. The only difference is that PFRS for SMEs divides financial instruments into two classifications, basic and non-basic. Basic financial instruments cover cash, loans receivable, commercial papers, and a lot more. There's an exhaustive list in your book, so check it out! Non-basic financial instruments cover derivative contracts, hedging instruments, commitments to make a loan, and to receive a loan if the commitment can be net settled in cash, and asset-backed securities such as collateralized mortgage. As a future practicing CPA, one should know what accounting treatment to apply. So, what treatment does apply? For basic financial instruments, it shall be measured at transaction price, which includes transaction costs. However, if the instrument is measured at fair value through profit or loss, the transaction costs are expensed. For subsequent measurement, it shall depend on the type of the instrument. Debt instruments shall be measured at amortized cost. Commitment to receive a loan shall be measured at cost less impairment. And if it is a publicly traded investment which is non-convertible, it shall be measured at fair value through profit or loss. As for non-basic financial instruments, they are initially measured at fair value or transaction price and subsequently measured at fair value through profit or loss. For equity instruments not publicly traded and with an unknown value, it shall be measured at cost less impairment. And that's it for SME's Basic Financial Instruments.